The Federal Reserve admitted that they were trapped. Stagflation is confirmed. And by the end of this video, you'll understand exactly why the Fed cannot fix it, what that means for your paycheck, your savings, and your cost of living, and why this time there is no rescue coming. Check this out.
The Fed just admitted in their own documents that inflation is rising, that employment is weakening at the same time. 16 of 19 members see prices going higher than forecast. 14 of 19 see growth going lower. That is the textbook definition of stagflation. Every economics course in the country teaches it. Then Jerome Powell walked to the microphone and said, verbatim, "I would reserve the term stagflation for a much more serious set of circumstances." That is not the situation we're in. What we have is some tension between the goals. Maybe added 3 words. Maybe that's just me. 5 days later, Bank of America published a note to clients. 4 words: classic stagflationary market environment. Not a warning, not a risk assessment, a description. Present tense. The largest bank in America is using the word. The chair of the Federal Reserve won't. So who's telling the truth? The Fed or the bank? Can they fix it? What happens if they can't? And what does this actually look like for your life if the word Powell won't say turns out to be the right word? Here's why the word matters more than the condition. Powell, at a previous press conference discussing inflation, real archival footage showing the evolution of his language. Powell insulated himself by never quite committing to a base case of how it would play out. The word isn't a label, it's a detonator. Powell knows it. He's navigated a pandemic, a war in Ukraine, and a tariff shock without ever committing to a worst-case name. Fortune described his strategy. Powell insulated himself by never quite committing to a base case of how it would play out. Don't name it, don't commit, wait. It's worked every time. The question is whether it works when the Fed's own numbers contradict the Fed's own chair. In normal times, the Fed has one problem at a time. Inflation too high, raise rates. Growth too slow, cut rates. The tool works because you only need to push one direction. Stagflation means both problems are live simultaneously. Raise rates to fight inflation, and you crush an economy that's already weakening. GDP fell from above 3% to 1.6 on the Atlanta Fed's own real-time tracker in a matter of weeks. Cut rates to support growth, and you pour fuel on inflation that's already above target. This inflation is fueled by the Iran war energy shock and tariff pass-through running simultaneously. Every move makes half the problem worse. That's what tension between the goals actually means. The financial terminal showing futures pricing a rate hike, the 52% probability moment in late March. Raising into that tips a slowing economy into contraction. Energy prices from the Iran war, diesel spiking freight costs, tariff pass-through hitting consumer goods, CPI heading toward 4% by summer. Cutting into that tells the market the Fed will tolerate inflation indefinitely. Once that expectation sets, it's almost impossible to reverse without doing what Paul Volcker did in 1980. Rates to 20%, a deliberate recession. Nobody in Washington wants to be Volcker. Nobody wants to be the person who crashes the economy on purpose to fix a problem they let run too long. Raise rates. Moody's has recession probability at 49%. GDP collapsing. Raising into that tips a slowing economy into contraction. Credit card rates go higher. Adjustable mortgages reprice. Small business borrowing costs spike. The households get squeezed from both directions. Hold rates. That's the current path. Inflation stays above target. Purchasing power erodes month after month with no resolution in sight. The market has priced in 0 rate cuts for the rest of the year. Some FOMC members are now discussing whether the next move should be a hike into an economy that's already decelerating. The Fed's own people can't agree which door is least bad. BofA's economist Claudio Irigoyen called it last week. The war dividends so far? Mild stagflation. He raised the inflation forecast to 3.6% and cut growth to 2.3%. Said the Iran war isn't just an oil shock, it's an energy shock, hitting natural gas and fertilizers at the same time. KPMG's analysis suggests a fear of stagflation inside the committee itself. The Fed's own members are positioning around the word their chair won't use. Consumer sentiment is at 47.6, approaching the lowest reading since 1932. The public doesn't need an economist to explain what they're living. The paycheck covers less every month. The costs don't stop rising. And the institution whose job is to fix it just told a reporter that maybe it's just him. 3 scenarios. What actually happens next? Path 1. Powell's bet pays off. The war ends quickly. Oil falls. Inflation eases back toward target. Growth stabilizes. The system survives by being right. This is the optimistic case, and it's not impossible. Powell has been right before. He said transitory in 2021 was wrong, then managed the recovery anyway. But this time is different. Path 2. Mild stagflation persists through the end of the year into 2027. Oil stays near 100, tariff costs embedded in consumer goods, inflation runs 3 to 4%. The gap compounds monthly. Not a crisis anyone officially names, just a slow erosion where your standard of living drops a little every month and nobody in Washington acknowledges it. Path 3, this is where it escalates. And it escalates on a specific date, May 15th. Powell's term as chair expires. Kevin Warsh, Trump's nominee, takes the seat.
Hey everyone, quick little interruption. Stagflation destroys people who don't see it coming. The Real Estate Crash Bundle, 4 courses that I put together for one crazy low price, shows you how exactly to protect your assets and how to find opportunities in real estate that only show up in this kind of market. Take a look at the link below. Now let's get back to the video.
Morsh has publicly argued that AI-driven productivity gains justify aggressive rate cuts. He wants to cut. He said so. He's built his case for the job around it. If he cuts now, he doesn't relieve pressure, he detonates it. A rate cut in this environment tells the bond market the Fed has chosen growth over inflation. The moment that signal lands, inflation expectations unanchor. Businesses start pricing in permanently higher costs. Workers demand higher wages. Landlords raise rents preemptively. Suppliers build inflation into contracts before it arrives. The expectation of inflation becomes inflation. It feeds itself. Once expectations unanchor, the only historical precedent for re-anchoring them is Volcker. Rates to double digits, deliberate contraction, a recession not as a side effect, but as the tool. That's what happened in 1980. Volcker raised the federal funds rate to 20%. Unemployment hit nearly 11%. It worked. Inflation broke. But the cost was millions of jobs and a housing collapse. That's path 3. The new chair cuts into stagflation, inflation accelerates, and the Fed is eventually forced into the most painful correction in modern economic history. Not because the economy failed, because the institution made the wrong move. What this actually looks like, not in economic language, in your life. Imagine pulling up to a gas station and the price hasn't dropped. You fill up for $80. You drive to the grocery store. The cart costs what it costs. None of it responds to anything the Fed did because those prices are driven by biology and supply chains and wars, not interest rates. You drive home, you open the credit card statement and it's higher than last month. You check your 401k and it's flat or down because the market can't decide which way to move when both halves of the economy are broken at the same time. That's not a recession. In a recession, prices come down. Stagflation is the version where you might lose your job and prices keep going up and the Fed can't cut because cutting makes inflation worse. The standard playbook, build cash, wait for the bottom, doesn't work. Cash loses value while you hold it. The bottom doesn't come because prices stay elevated while growth stalls. In the 70s, it looked like gas lines. Double-digit unemployment and double-digit inflation running simultaneously for years, not months, years. Families watching everything they built get compressed from both sides, income shrinking and costs rising, until Volcker deliberately crashed the economy to break it. That was the fix. That's what the fix looks like. You can't prepare for stagflation the way you prepare for a recession. In a recession, you build cash and wait. In stagflation, cash erodes while you hold it. Watch the signals that tell you which path is unfolding. The Atlanta Fed GDP Now tracker, if growth keeps falling while inflation stays above 3, mild is hardening into structural. Oil prices. If Brent stays above 100 through summer, the energy shock isn't temporary. May 15th, when Warsh takes over, watch the 10-year yield on the day of his first rate decision. If yields spike on a cut announcement, the bond market is telling you that the cut is making inflation worse, not growth better. And the person about to make that decision might not even be seated when the moment arrives. Warsh has publicly said he'll make monetary policy based on anecdotes over data. He called data dependence among the most dangerous words. A news headline about Powell's term ending May 15th, 2026, the transition visible. The institution that's supposed to steer the economy might not have a permanent leader when the storm hits. But here's the part that should concern you more. His confirmation is stalled. If Warsh isn't confirmed by May 15th, Vice Chair Philip Jefferson serves as acting chair, a caretaker. During the most complex monetary policy environment since the 70s, the institution that's supposed to steer the economy might not have a permanent leader when the storm hits. If it goes wrong, if Warsh cuts and inflation unanchors, global recession is the modeled outcome, not U.S. slowdown, global recession. The 70s caught a generation off guard because none of this was accessible to ordinary people. It is now. You're hearing about the trap before the chair changes, before the first cut. That's not panic. That's the only edge available.